Hey everyone, welcome back. Like Mace, I am back with another dividend stock investing video. I want to cover McDonald's in the video today. This is a stock that I own. They just increased the dividend by 7%. I want to share my personal experience investing in McDonald's because I am up 213% on my investment. That is including all capital invested. I am up 213%, and I'm yielding over 7% on cost on my McDonald's stock. And so I want to share that because it is a real-world example of this concept of the dividend snowball. I have held this stock for 10 years now. And in 10 years' time, that's what I've accomplished. So get ready, everyone, for a really exciting dividend investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I'm going to jump right into the analysis, and then I'll have a second segment where I go through some of their recent news and earnings. So check it out on the screen right now. What you see in front of you on the left-hand side are some statistics about McDonald's stock. It's trading at $243.08. Based on the analyst earnings expectations, they're going to earn $9.08 per share this year, $9.90 next year. And that puts them at a forward PE ratio of 26.77 this year, 24.55 next year. So this is certainly an expensive stock right now, but it is also a world-class core company that I love so much. It is one of the larger positions in my portfolio. And I think the reason it's so expensive is because this is a company of pure quality. Based on their dividend per quarter of $1.38, their annual dividends come out to $5.52 per share. And so the starting dividend yield right now is 2.27%. Not too high, but I guess in this world right now where stocks in general have been trading very high, it's, I guess, characteristic of the market that we're in. The payout ratio is 60%, and based on their 2016 dividend per quarter, the comparable dividend per quarter of 94 cents, they have been increasing the dividend per year on average by a staggering 8%. Market cap is $181.5 billion. There are so many reasons I love this company. I love this company because they own so much real estate. I love this company because they've found a really successful model of franchising out most of their stores. I love this company because they have brought technology into the mix, and they have opened a Silicon Valley office and are integrating so much tech into what they do. But I don't need to go through all of those reasons today. I have covered those throughout the years, and I will include my original McDonald's video in the description below if you want to watch that. What I want to get into, though, is my personal performance. So check it out on the screen right now. What you can see on the right-hand side of the screen are my statistics. I started buying this stock in 2011 at $73.53. Now, my average share price that I have spent in acquiring McDonald's shares is $77.61. And so how did I arrive at this? I basically looked at all of the dollars that I invested in this company. I divided by the number of shares that I own, and that's how I got my average price per share. Now, really important to note, I don't include dividends reinvested in the dollars invested because that's free money, if you will. But I do include the dividends reinvested in the shares. The dividends reinvested produced more shares for me. I'm only looking in my average price per share at the actual raw dollars that I put into this thing. Dividends thrown off of the company and reinvested, I'm not looking at those in this equation in terms of dollars invested. That's a really key point in computing an average price per share for these purposes. Now, if I take my average price per share and I kind of go down the same table that I did on the left-hand side, I have a metric that I highlight here called PE ratio on cost. If I take the analyst estimates for earnings this year and next year and I divide by my average price per share, you can see my PE ratio on cost right now is an 8.55 this year, 7.84 next year. And so that's a metric I just like looking at. And the reason I look at PE ratio on cost is it gives me a sense of built-in stability. It gives me a sense of kind of risk, if you will. The longer that I have owned this company, the less risk I have, the more I have de-risked things because my PE ratio on cost is so low. It's just a fun metric that I like to look at. It's another way of looking just not only at dividend yield, but total kind of earnings yield, if you will, that I have received by owning this stock so long. Let's keep going. Check it out on the screen right now. And so next what you see is just this dividend information, same as on the left side. They're paying $1.38 per quarter or $5.52 per year. But if I take my $5.52 and I divide by my average purchase price of $77.61, that's how I get my real total dividend yield on cost of 7.11%. And this is the dividend snowball right in front of your eyes. The dividend yield right now is 2.27 for people buying today at $243, but my real dividend yield on cost is 7.11 because my average purchase price is $77.61. And the reason my average purchase price is so low is I bought this thing a long time ago, but also I've been receiving a ton of dividends over the years. All of those dividends have been going back to purchase more McDonald's shares, which in turn are paying more dividends. And you add on a dimension on top of that, that the dividend is going up each year. For the last 45 years consecutively, McDonald's has increased their dividend. And over the last 5 years, they've increased it 8% per year on average, which is just staggering. Let's keep going. Check it out on the screen right now. And so what you can also see is the market capitalization, $181 billion, so good sized company, but still a lot of room to grow. And I have some interesting notes that I want to share with you at the bottom. And so my average price per share is really low, despite buying shares below $100, in the $100 range, and even in the $200 range because of reinvested dividends. This is the miracle of dividends. I have had a lot of time on my side being in this position for 10 years. So how much am I up? Basically, I am up 213% in terms of capital appreciation. I have to share it because that's what most people look at. I don't really care about it because I'm only investing for cash flow. Still, it's nice to see, though. Over a 10-year period, certainly it is illustrative of my success and the company's success, and so I think it's important to illustrate that in the video today. Each dollar that I invested is worth $3.13. And so one other interesting metric is if you just look at, like, I don't display all this in front of you, but when I did my analysis at home, because I'm updating a lot of my records, a lot of my bookkeeping, in addition just to the raw dollars invested, basically I wanted to understand how many dividends got reinvested as a percentage of raw dollars invested. Over all of these years, I got another 35% boost, if you will, in terms of just capital infused into this company, because that's what came out of the dividend reinvestment. And so that's a key thing to keep in mind for dividend stock investors, is it's not just about owning the stock. It's not just about the increasing dividend over time, but it's reinvesting the dividend can add so much fuel to the dividend snowball. And you can see that with the numbers right in front of you, how I'm up 213% and I'm yielding over 7% yield on cost on McDonald's, even though it yields only 2% for a starting yield right now. And so, by the way, I got to include this in the video. Here's a Happy Meal toy that my daughter wanted me to include in the video today. This is Scooby-Doo. And so obviously McDonald's is a great stock for kids as well. My kids don't own any McDonald's yet. They own Disney and Hershey. Hershey Company has been doing well for them. Disney's been doing well for them. Maybe at some point I will add McDonald's to their portfolios as well. But for now, we do enjoy going there from time to time, especially for the Happy Meals. Let's keep going. Check it out on the screen right now. And so what you also see at the bottom of the screen is this is the dividend snowball in action, and it makes me wonder if it's just best to stick with the basics, these core stocks. It's kind of boring buying McDonald's for me because it's such a big position, but sometimes Honestly, I go and I buy ancillary positions and I enjoy that, and it kind of keeps me interested. I bought a new stock today, Dutch Bros. I will cover that in an upcoming video. That one pays no dividend. It's a very small position in my portfolio, but I'm going to explain to all of you why I did buy that stock. But sometimes I think, Ian, instead of chasing some of these ancillary positions, should you just keep with the boring stocks like McDonald's because it works so well? It's so tried and true. And in general, honestly, that's kind of where my mind is at. As I go into 2022 and I look at my strategy for the new year, it's probably going to be really focused on core stocks, high yielders, or high yielding core stocks, if you will. And so that's where I'm at right now. Anyway, as it pertains to this analysis, it does not include taxes. And so obviously taxes are another element to it all. And all of those dividends that did get reinvested, I got taxed on those along the way as well. And so worth pointing out to everyone at home, especially those that are looking at all the details. Now, I want to get into segment 2 of the video, but before I do, please smash the like button. If you enjoy this video, if you love McDonald's as much as I do, dividend stock investing as much as I do, also don't forget to subscribe. I have more videos on the way all the time. And everyone, thank you for hanging in there. I know this video is a little bit late. I was traveling last week, really exciting times. And so I was checking in on the new home that's being built for us. And so I'm excited about that. And so I was really busy last week. But on the airplane, I prepared this video and another one for you all as well. And so I'm getting those geared up. Thanks for your patience. Anyway, segment 2, I want to share a few things about McDonald's. Check it out on the screen right now. And so the first thing I want to share is the most important thing that, hey, they increased the quarterly dividend by 7%, and they're going to be buying back shares again. So McDonald's as a business is doing really well. And this is the 45th consecutive year of doing so. And so tried and true, boring, old dividend investing. It's not so exciting as some of the startups and IPOs and those kind of things, which I think should have a place in a well-rounded portfolio as well. But boy, this tried and true dividend strategy sure works. Let's keep going. Check it out on the screen right now. And so the next thing I want to show you is they had a great Q2. This was reported a few months ago, but their global sales were up 40.5% in the second quarter. And I like that they do a 2-year basis as well, because obviously last year was a bad comp with the pandemic. But even on a 2-year basis, they're up 6.9%. So the business is growing. And the U.S. sales, you can see, increased 25.9% or 14.9% on a 2-year basis. And international markets, 75% growth, 2.6% on a 2-year basis. And that just reflects, boy, how bad international was during the pandemic when everything was closed down. I have more to share, so check it out on the screen right now. The next one that I want to share is just comparable sales, and it shows by market. US, we just talked about that. It shows international operated markets, and it shows international developmental licensed markets and corporate. And so breaks it down into 3 buckets, and in all 3 buckets, they are growing year over year. Now, one thing I want to show with McDonald's that is very interesting and important is their income statement. So check it out right now in front of you. And what you see on the income statement all the way at the top, I'm not going to go through this in great detail, but I want to point out one thing, because if you're at home and you're thinking of investing in restaurants like I do, I own McDonald's, I own Starbucks, I now own Dutch Bros. And so I analyze a lot of restaurants. And when I analyze restaurants, one thing to keep in mind, especially with these types of restaurants, is they have franchise stores. And if you know something or two about McDonald's, they've franchised out most of their stores because their franchisees will operate the stores better than corporate. And that makes sense because it's a hyper-local strategy. The local operators know the local market the best, and they just have 1 or 2 or a few stores to operate, and they operate those stores the best, better than corporate can. And so basically what you see here under revenues is you have sales by company-operated restaurants. And so it's a big old number here at $2.488 billion. And so that's the sales from company-operated restaurants. But that's a very small sliver of their business. But then you can see it doesn't say sales, it says revenues. Revenues from franchised restaurants, $3.3 billion. And so this is really important. It says sales from corporate, revenues from franchise. The reason it says revenues is that's the money that McDonald's corporate gets as a fee from the franchised restaurant, but it doesn't represent the sales actually that the franchised restaurant is doing. And so the fee that McDonald's collects, and the fee, they have like franchise fees, but for a lot of these restaurants, McDonald's actually owns the land, the real estate, and so they rent it out to the franchisee, and so they collect money that way as well. That's what you're seeing when it says revenues from the franchised stores, but you're not seeing the overall sales that the franchise stores, the restaurants are contributing. Now, that revenue that comes through from the franchise stores, that's really high margin revenue, and it's not the same as sales that are coming in the company stores, because the sales from the company stores, you have to take out the cost of goods sold, you have to take out all the labor, all of the marketing, so on and so forth. And so just something to keep in mind, because a lot of people look at McDonald's and they're like, hey, Ian, why do you invest in this thing? Revenues are down when you look at it like this decade versus the last decade. And the reason for that is McDonald's changed their strategy, and instead of managing a lot of the stores themselves, they started franchising out more and more and more and more because the franchisees are operating them better. And so when you look at the income statement, yeah, overall revenues look down, but that's just because of the way it's reported. They're not reporting system-wide sales. They're just reporting sales from the company-owned restaurants and the revenues that they collect from the franchised stores. And so something really important to keep in mind when analyzing McDonald's, Starbucks, or any restaurant. And what I'll tell you, actually, I was doing a comparison of Dutch Bros and Starbucks. That's what I'm going to present in an upcoming video. When you look at Dutch Bros, it's really interesting because on their IPO filings, their S1, they were discussing system-wide sales. And so they have franchise stores too, but they actually were reporting on the total sales that those stores were doing, which was really helpful for an investor like me who likes to dig into the numbers. Anyway, let's keep going. Check it out on the screen right now. The next thing I want to show you with McDonald's is just a breakdown of the stores. You can see that they have conventional franchised. It's 21.5 thousand. Of those franchised. They have developmental licensed of 7,753. They have foreign affiliated of 7,445. And so total franchise, they have 36,717 of these. Company operated stores is a tiny 2,679. So you can quickly see what I was saying with McDonald's on the income statement. The sales for their stores, it's just representative of those 2,600 stores. But the revenue coming in, which from the franchise stores, which is a really good margin revenue, that's from all of this 36.7 thousand stores. And so what do you guys think about McDonald's? Drop some thoughts in the comments below. I would love to hear. How has been your success investing in McDonald's over the years? This is one of the ones that I bought during the pandemic when things were dipping. I knew it would bounce back, so I went ahead and I bought more McDonald's, and so I'm proud of that. And if you enjoyed the video today, please smash that like button. It means the world to me. Please don't forget to subscribe as well. All right, everyone, before we leave today, in terms of a full disclosure, I own the stocks mentioned today. I'm long McDonald's, MCD, Starbucks, SBUX. I'm also long Dutch Bros, BROS. And my kids are long Hershey Company, HSY, and Disney, DIS. I own all those stocks just mentioned, or my kids own the two stocks just mentioned as well. In terms of a disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose a lot of money in the stock market. I shared a really good case study today of the dividend snowball with McDonald's, but I have made my fair share of mistakes out there in the stock market as well, and it's possible to lose money as well. So proceed with caution and consult your licensed financial expert. I love you all. Thank you for the support. I'll see you in the next dividend investing video.